This is a wide shot of the New York Stock Exchange floor in the late 20th century. For decades, the premise of building wealth in America looked like this. You took your savings, responsibly bought a fraction of a stable blue-chip company, and held onto it for 40 years to fund a quiet retirement. But for millennials and Gen Z, that math stopped working. Stagnant wages met an impossible housing market, and young adults found themselves buried under thousands in student debt before they even received their first paycheck. When a slow and steady retirement plan becomes a mathematical impossibility, people look for an escape hatch. That creeping despair created a massive psychological vacuum, perfectly primed for high-risk gambles. Before 2020, a small corner of the internet known as the subreddit WallStreetBets began filling that vacuum. At the time, it was a niche community of early middle-aged professionals in finance or software, writing dense, highly technical reports, known as due diligence, on obscure commodities. Then they discovered financial derivatives. A derivative is a complex financial contract whose value relies on an underlying asset, like orange juice futures. This split-screen graph shows the appeal. On the left, a traditional stock grows in a slow, flat line. On the right, a highly leveraged derivative contract violently spikes upward and crashes downward, meaning a user could achieve massive wealth or absolute ruin with a single click. This all-or-nothing approach to investing perfectly aligned with the popularization of YOLO, or you only live once. Traders began sowing their entire savings into single, highly volatile trades, and posting their inevitable losses online as a badge of honor. By abandoning investments in actual businesses for gambling on complex derivatives, this community laid the institutional groundwork for a massive collision with the broader market. In early 2020, the COVID-19 pandemic forced millions inside. This photo of barren grocery store aisles captures the pervasive fear of those early lockdowns, when many young people genuinely believed the global economy was collapsing entirely. Then came the cash. The U.S. government issued sweeping economic impact payments, like the $1,200 check seen here, alongside enhanced unemployment benefits. Suddenly, panicked adults had thousands of dollars in disposable income. This new demographic flooded the subreddit. The massive influx of inexperienced retail traders drowned out the old guard's careful financial analysis, replacing it with herd mentality meme trading and inside jokes. Because users felt the world might be ending anyway, the actual loss of money stopped mattering. The stock market morphed into a massive nihilistic online support group, heavily subsidized by government cash. With millions of new users, the community shifted to narrative trading. Instead of looking at balance sheets or revenue projections, users bought stocks based entirely on simplistic, easy-to-follow internet stories. One massive trend involved buying Activision stock. The narrative was simple. Everyone was locked at home playing Call of Duty, so profits would skyrocket. The traders completely missed that Activision's actual highest-grossing product was Candy Crush, a game primarily played by moms waiting at airports, who were definitely not traveling. This era also birthed the SPAC bubble. A SPAC, or Special Purpose Acquisition Company, is a publicly traded shell corporation used as a legal backdoor to bring a private company public, completely bypassing the rigorous financial vetting of a traditional IPO. The absurdity peaked with Nikola Motors. The company achieved a staggering $30 billion valuation, more than Ford Motors, using almost nothing but Fiverr-commissioned 3D renders of a hydrogen truck. They literally filmed a truck rolling down a steep incline with no functioning engine, while the CEO boasted about a non-existent HTML supercomputer. In this euphoric environment, the stock market detached completely from reality. Investors actively rewarded brazen, fabricated storytelling over viable business models. The danger of this detachment crystallized when oil markets crashed. This chart tracks West Texas Intermediate crude oil futures plummeting below the zero axis. One trader bought contracts at the bottom and bragged to WallStreetBets about locking in a $26,000 profit on a single remaining contract as the price hit -$4. But he made a ruinous error. The contract he purchased was not cash settled, meaning it didn't just pay out the difference in money at the end of the term. He had accidentally purchased $26,000 worth of actual, physical, unrefined crude oil. Because of the specific derivative he bought, that crude oil was legally required to be physically delivered to him. Specifically, it was headed for the massive industrial storage tanks in Cushing, Oklahoma, seen in this aerial photograph. This single catastrophic trade proved exactly what was happening across the platform. Retail traders were recklessly wielding highly complex financial weapons they lacked the basic knowledge to understand. The ultimate climax of this era arrived in 2021 with GameStop. A user named Roaring Kitty noticed that Wall Street hedge funds had placed massive bets against the failing brick-and-mortar video game retailer. His idea was to trigger a short squeeze. This cyclical feedback loop shows how it works. If retail buyers force the stock price up, institutional short sellers are contractually forced to buy the stock to cover their losses. That forced buying makes the price spike even higher, creating a temporary infinite money glitch for early buyers. A global mania ensued. Millions of men poured their savings into GameStop, and the valuation rocketed past $30 billion. Even legendary investors joined the frenzy, guided by billionaire George Soros, pictured here, who famously said, "Show me a bubble and I'm buying." Then the system broke. GameStop's stock price abruptly collapsed for one specific reason. The brokerage app Robinhood unilaterally turned off the buy button for its retail users. This intervention suggested that the rules of the market only applied as long as established institutions were winning. For millions of retail investors, it confirmed the suspicion that the system is a closed loop designed to protect institutional capital at all costs. The psychological fallout was immediate. Looking at the bronze Wall Street charging bull, retail traders felt their one brief triumphant moment of actually occupying Wall Street had been illegally stolen by deep state connections. A strange cognitive dissonance settled over the community. Older members developed elaborate defense mechanisms and grand conspiracies to justify the massive amounts of money they ultimately lost chasing the GameStop high. Despite the feeling of a populist victory, the traditional financial hierarchy remained intact. Wall Street simply absorbed the shock, quietly siphoning the massive wave of retail stimulus cash back to the wealthy. Today, WallStreetBets has settled into a comfortable, massive finance news and meme board. The dense analytical roots and the chaotic, world-ending energy of the 2020 era are largely gone. But the movement left a lasting mark, the gamblification of modern culture. Corporate interests recognize the addictive power of these chaotic trades, accelerating the push to embed lottery-like features into everything from trading apps to daily entertainment. Young people are turning to extreme financial lotteries because traditional paths to a stable future, like homeownership, appear permanently blocked. In a world where a savings account can't outpace inflation, the high-stakes gamble becomes the only perceived route to a mortgage. WallStreetBets is the escapist symptom of a generation that has stopped believing in the future. Against the backdrop of the U.S. Capitol building, the subreddit reflects a structural failure, a world where gambling is the only logical response to a broken economy.